Hello and welcome to our Construction Market Trends webinar hosted by Skanska USA Building. I am Katie Wilson, Senior Director of Business Planning and Strategy, and I have the pleasure of being your moderator today. Thank you all for joining us. We would love to know what part of the country or what markets and industries you work in, so please feel free to let us know in the chat. This webinar is meant to accompany Skanska's quarterly market trends report that covers supply chain trends, material pricing, labor changes, and other related construction indices. We'll drop the link to the report in the chat. Please be sure to check it out after today's webinar if you haven't done so already. Before we dive in, I'd like to take a moment to recognize that this is Women in Construction Week. Over the past year, we've continued to see encouraging workforce trends. 1 in 7 new jobs in construction has gone to women, helping maintain women's participation at just over 11.2%, the highest we've seen in more than 2 decades. This year's theme, Level Up, Build Strong, really reflects what we're seeing in the broader market: resilience, growth, and a more diverse workforce stepping into critical roles across our industry. And while women still only make up 4% of field positions, the momentum is real, especially as we look towards labor challenges and opportunities shaping 2026. Yet there's still work to be done. Bringing more diversity into our field is a continuous effort. Women in Construction Week continues to shed light on our achievements, and this week we celebrate the strides we've made. With that, let's shift into today's programming. I'd first like to introduce our guest speakers for today. Rob?
Hi, I'm Rob Catando. Good afternoon. I'm the National Supply Chain Director for Skanska. Great to be with you.
Hi, I'm Steve Stouthammer. I lead project planning and pre-construction services for Skanska USA Building. Nice to be here with you.
Hi, I'm Ken Simonson, Chief Economist for Associated General Contractors of America, the leading national construction trade association.
Awesome. Thank you, everybody. Today, we're focused on what's ahead in 2026 after an uncertain 2025. First, Rob will dive into supply chain and materials, and then Steve will provide an outlook for project planning, including what you need to consider from inflation to labor availability and busy markets as you plan for your projects in 2026. And then we'll conclude with Ken, who will discuss pricing, sector trends, and how immigration is impacting job growth. If at any point you have questions for our speakers, please add it to the chat. We have reviewed the questions you've submitted beforehand and have worked much of that into our content. However, we're hoping to save some time at the end for question and answers. We may go about 15 minutes or so past the hour to answer those questions. If we can't answer your questions in the time we have allotted, we'll be sure to follow up with you directly. Finally, know that we'll be sending a recording of this webinar and all the materials to all of you after we conclude. With that, I'd like to ask Rob to dive into our supply chain and materials update. Rob?
All right, great. Thanks, Katie. So let's first start with tariffs. We've been getting a lot of questions recently about the Supreme Court ruling and which tariffs have been affected. So I first want to start with the column all the way to the left here, the reciprocal tariffs, also known as the International Emergency Economic Powers Act tariffs. These are the tariffs that have been struck down by the Supreme Court on the grounds that they were levied illegally by the executive branch. It's important to note that the other tariffs listed here on this slide still in effect. But let's talk about each one of them. So the 232 tariffs. These are levied to protect industries that are deemed vital to national defense. Because they're targeted at metals, and those metals affect the construction industry, these are the ones that have the biggest impact on our supply chains. And we're talking about the 50% tariffs on steel and aluminum and copper, and also the 10% tariff on lumber. The 301 tariffs, these were in place to combat unfair practices. These are mostly targeted towards China for things like intellectual property theft. It's important to note that these can't be immediately implemented. They require study by the U.S. Trade Representative or the USTR. The Section 122 tariffs, these are the new 10% global tariffs. These are the ones that have been put in place in reaction to the SCOTUS ruling. These allow for tariffs to combat fundamental payment problems. Tariffs levied under this authority are temporary and can only be in place for 150 days unless extended by Congress. Interestingly, yesterday, Treasury Secretary Scott Bessent stated that these tariffs will likely increase to 15% sometime this week. So in summary, when we look at all the tariffs here, it's just the reciprocal tariffs that have been struck down. All these other ones remain. So let's talk a little bit about what's ahead in the last column. So as mentioned, the 122 tariffs, they're set to expire in July. But more importantly for construction supply chains, let's talk about USMCA. That's going to be up for review in July, and that's the revised NAFTA agreement. During the review, the US, Mexico, and Canada are going to discuss the current terms of the agreement and decide if they want to extend it or modify the agreement. So Mexico and Canada, they're critical trade partners for us in the construction industry. Many of the products they ship into the US are exempt from tariffs under the terms of USMCA. Some of the key materials, HVAC and electrical equipment and components, steel, aluminum, cement, and gypsum. So any modifications to USMCA are likely going to have a significant impact on construction supply chains. And then the last thing we'll note is in the February 20th announcement from the White House announcing the Section 122 tariffs, if you read down to the bottom of that, there was mention that USTR was being directed to further investigate 301 tariffs to see if there were other things that should be enacted under that section of the trade law. So we're going to be watching these three developments very closely. Let's flip to the next slide, and we're going to do a quick view of before and after the ruling. So this is what tariffs look like going into the beginning of this year. You can see the tariff base rate line here. Those are essentially the reciprocal tariffs, the exception being China. In the number listed there for China, there are 301 tariffs included in that number. The 232 tariffs are shown at the top right. And on the lower part of the chart, you're going to see a couple of things. You'll see the full year 2024 share of each of the partners in terms of their imports into the US. And then below that, you'll see the major construction materials that they provide. So let's flip to the next slide and we'll look at the post-SCOTUS view. So you'll see the base tariff rate or the reciprocal tariffs have been struck out. You'll also notice that the 232 and the 301 tariffs remain at the top there, and the 122 tariffs have also been added in the top section. Going back to the share of imports, interesting to note, when you look at full year 2024 compared to 2025, there's some definite winners and losers here. So China lost about 6% share with the US, and Mexico picked up a couple of points. Canada and the EU are essentially flat from where they were last year. So later in the presentation, we're going to talk a little bit about how these tariff changes affect construction materials. But I first want to dive into metals and talk about steel, aluminum, and copper. So let's first jump into steel. So the chart you see here, this is for hot rolled coil steel. As you can see, the pricing's been on a steady upswing since the fall of last year. So coil steel is used in a number of different construction categories. Things like metal studs, metal panels, HVAC equipment, and ductwork, as well as electrical gear. So pricing impacts in construction can most easily be seen in metal studs, where major manufacturers have announced 3 separate increases since this hot rolled coil started going up. Those increases were between 10 and 15%, and they were announced in November, January, and most recently in March of this year. So in addition, when we look at structural steel is also rising. Wide flange pricing is up more than $100 per ton since October. So pricing for domestic mills is now inching towards the price of imported steel, even after factoring in tariff costs. So with this gap closing, lead time advantages in sourcing to foreign mills may become attractive in some cases. The last thing I'll mention on steel is we're also seeing a new dynamic happening in the steel marketplace, and this has to do with large mega projects. So what we're seeing is when we look at fabricators, the very large fabricators that can handle these mega projects, they are now booking orders out through the end of 2026. So those lead times have been extended pretty significantly. So we're really seeing a bifurcated market now where you've got the larger steel fabricators on one side and the smaller steel fabricators, they're booking orders for mid-year. So the lead times have become very different in those two parts of the market. So let's next take a look at what's happening in the aluminum world. So the chart you're looking at here, this is the Midwest premium for aluminum. This measure best depicts what's happening with aluminum as a result of tariffs. So let me explain what this is. The Midwest premium is a surcharge that gets added to the London Metals Exchange base price, and it captures the added cost for delivery of aluminum to the US. So this includes things like transportation, logistics, and most importantly, tariff costs. So this premium, when you look at the chart here, it's up by a factor of 3.5 times since the beginning of 2025. So this really shows how aluminum pricing has escalated in the US above the rest of the world. So what does this mean for construction? This escalation has hit the curtain wall and storefront extrusion manufacturers. They've all announced increases during 2025 and early in 2026. So we're seeing those effects come through in construction materials. Last, I'm going to talk about copper. Copper pricing climbed to record highs in January, topping out at $6.20 a pound. The main drivers behind copper's rise: data center demand, trends towards electrification, and also speculative buying. So similar to gold and silver, copper futures and physical copper are often traded speculatively as a hedge against inflation, geopolitical instability, things like that. So pricing for all three of those metals have really surged recently. When you talk about impact to construction supply chains, that can best be seen in the price of copper wire and copper pipe. Both of those are up 25 to 30% since the start of last year.
Yeah, wow, Rob, metals are an all-time high. Is there anything our customers should know about how to mitigate this impact?
There's the typical substitutions that can be investigated and considered. Things like aluminum in place of copper wire, CPVC in place of copper pipe, concrete structures in place of steel structures, and even adding fiber reinforcement to concrete mixes to eliminate or reduce the amount of rebar you need in a mix. But there's also another one that's not as obvious, and that really is looking at specifications. It's important to make sure your specifications are open for things like HVAC equipment, where there's a big metals content. The more you can drive competitive bidding at that second tier of the supply chain, you're going to be able to minimize the impacts of those metal increases coming through to your project.
Okay. Yeah, that makes sense. Thanks.
So the last thing I want to talk about is our category slides that we show during every market trend. So the first thing you'll notice here is we've got some categories highlighted in blue. Those are the ones that are most significantly dependent on the metals markets. And you'll see when you look at the expected changes that we have noted at the very bottom, those are the ones that we're expecting the highest degrees of escalation. So diving into some more detail on here, the one thing you'll notice about lead times is we are expecting lead times for HVAC equipment and electrical gear to fall this year. And that's really due to expansions continuing to ramp up. There has been some significant investments by many manufacturers in this area. We also expect pricing increases to slow for HVAC equipment and plumbing fixtures because of the elimination of the reciprocal tariffs. You can see we've revised things by a few percentage points. If we look at the second category slide, you'll notice on this one that the electrical commodities, we'll talk about that. We also expect the increases in that category to slow this year as well, mainly because of the high percentage of things like lighting fixtures and commodity electrical goods that are produced in China. So important to note, we don't expect pricing to decline as a result of the tariff action, but we do expect, as noted, some of the escalations to decrease this year.
Thanks, Rob. That's a lot of great information on how pricing and lead times are trending. I know it's still early days, but with the conflict in the Middle East, how do you anticipate this impacting the construction industry and the supply chain?
So yeah, it's still early days, but I'd say the obvious item really is oil, right, from that part of the world. So crude oil has already topped $80 a barrel. That hasn't happened since late in 2024. We're seeing an immediate effect on diesel fuel pricing. That's up in the $4 a gallon range now. But in terms of materials, it's going to take a little while for any pricing impacts to work their way through the supply chain. But in terms of construction materials, you have things like asphalt, roofing, waterproofing, foam insulation board, PVC piping, just to name a few. And really the extent of the impact is really going to depend on how long this conflict lasts. And not only that, the US is stating that they're going to provide escorts for ships going through the Strait of Hormuz. So how successful they are in making sure that ships get through there is really going to have a huge impact as well.
Yeah, thanks, Rob. Lots of things at play there, and we'll see kind of how it plays out over the next coming days and weeks, hopefully not too long. But thank you so much, Rob. If you have additional questions for Rob, please add them to the chat and hang on for our Q&A session at the top of the hour. So now that we have an understanding of the supply chain and materials, let's bring back Executive Vice President of Project Planning, Steve Stauhammer. Welcome back, Steve. And we're going to talk about the outlook for project planning and what's ahead for pricing and inflation in 2026. So Steve, I think one of my first questions here is in our market trends report, we show a composite cost index and ENR building cost index having a 1-year increase of 6.8% and then 3.9%, respectively. And then when it comes to MEP escalation, we're showing 11%. And Ken's going to talk about this in more detail later, but the PPI special indexes, construction materials, have been spiking since late 2025. And overall, it seems like costs are outpacing inflation, at least in the construction industry. How do you think pricing is going to rise later in 2026 and into 2027? And what are your thoughts on how owners and customers and developers should be planning for construction cost escalation?
Yeah, that's a lot. Great question, Katie. I'd say if you've checked out the trends report and the forecasts from some of our regional pre-construction leaders, you can see their reactions are somewhat mixed across our markets and how they're thinking about short-term and long-term escalation. There are a number of markets where the labor force, particularly in the MEP trades, is feeling a real strain, being significantly impacted by the scale of data center work, the ramping up and growth of life science, particularly drug manufacturing facilities, and the related high-tech work for both of these sectors. And to a degree, some of the impact that could be worse, but we have seen some sectors pull back a bit, certainly commercial development, offices, multifamily residential. The interest rates affecting those markets have led to kind of reduction in their work. So that's, help us see a shift basically of market resources to these higher tech projects. But I think the short answer is we think cost escalation in construction is going to outpace U.S. inflation, and fairly significantly. You see most of that middle shade of blue is our teams are forecasting in the 4 to 6% range. I think we actually will come back to in a minute what looking back look like, because I think we've been on the upper end of this for the past 12 months. But how do you best plan for this inflation? And maybe just to touch on a few thoughts there. I think there's a lot that goes into it. I always recommend to our teams and our teams to our customers, very important first to kind of look at how dated is your current budget, right? When was the last time it was refreshed? Budgets get pretty old pretty quickly when the market conditions are what they are. How close is your project in terms of the procurement and construction phase when is it likely going to occur? That'll take into consideration sort of the percentage you might want to allow for escalation. What's the labor situation like in the local and regional market you're in? Some markets are more challenging than others. And then are you considering how material costs are being impacted from tariffs? So just a few core pieces of advice. I definitely always recommend to bring in your general contractors to get their advice from their pre-construction teams on what they're experiencing in the market, to check your budgets as clients. They're experiencing it firsthand. And we have a really good sense of what the current costs are for different types of projects. I'll always recommend to customers that you forecast escalation to a midpoint of construction, generally is a better practice than just to when you get to the procurement phase. And I say that because when you're procuring, the subcontractors that are bidding to the general contractors, they have to take into consideration purchases that they might not be able to lock down at the time of bid, that they can't make for several months. So it's a good practice to kind of account for what they have to account for. And then certainly, I think it's important to evaluate each trade. And as Katie led with the question, the MEP trades have really been growing at an exponential pace in comparison to the other building trades. We've mentioned in the past that ENR and their index tracks most of the architectural or structural building trades. But when you think about the impact that the high-tech projects, the data centers, the life sciences project and related projects are having, it's really being felt the most with the MEP workforce. And almost that's close to 3 times the pace of the architectural trades. And that is why we've built this kind of composite index to look at what we believe the actual full inflation factor has been for the industry. And you can see the last 12 months, so almost 7%. So that's very significant. And I would certainly suggest, as you're starting to think about forecasting escalation, you make sure it kind of considers all of those trades, and that trade by trade view is often a good way to forecast escalation, not just applying a factor to all the trades similarly, but individually looking at each trades and paying careful attention to the MEP trades for sure.
Yeah, that makes a lot of sense. I mean, that MEP difference is so much greater than those other trades. So you mentioned the impact of the data center construction, and I think the MEP definitely has a big piece of that. But data center, power, and mega projects continue to be in the spotlight, and these projects are having a ripple effect across the whole industry. What's your best advice when planning for other project types in the markets that are saturated with this type of advanced manufacturing work? And we also got a question about this from one of our registrants. They want to know what other products are tied to this market, and how is the increasing demand in those markets leading to longer lead time across the, all the markets, and if there's a projection on when this demand will stabilize. Can you speak to that as well?
Yeah, maybe to address the question at the end there first. Certainly we're feeling it, and it's easier to see in terms of major equipment like generators, switchgear, major mechanical HVAC cooling equipment like chillers and different air handling systems. They have much longer lead times than we experienced in years past, and the pace, while we think the pace of growth in the data center market may slow a bit, it's still got a significant double-digit annual growth percentage predicted for the next several years. So if you kind of look at this map, I think a few years ago, we had a number of regions in the country that could probably hide from what the data center impact was doing. But now that demand is spreading across the country to locations where there's power capacity, land availability, and most markets around the country are feeling the impacts of the significant growth in the data center market. And to get a sense of scale. So if you move to the next slide, this year in the United States, either being delivered or under construction are over 8 gigawatts of data center. And how much is that? Just for, that's about 32 million square feet of construction of just data centers across the country. Somewhere a spend of somewhere between 40 to 80 billion dollars, absorbing about 50 to 75,000 electrical craft alone, workers, right? And that's, depending on estimates of the total electrical capacity of the country, you're starting to push close to 10% of all electricians, not just licensed electricians, but all folks operating either as licensed electricians or in the craft of the electrical field, close to 10%. Very significant. And I'd say estimates would suggest that by the year 2030, the electrical workforce needs to grow by about 130,000 workers, as I've read, to kind of keep up with the demand that we're expecting to see here. And again, I would be remiss to just focus on data centers here. I'm sure we have some people tuned in today in the life science sector that is growing kind of exponentially, maybe not as countrywide in all locations, but several of our markets around the country are feeling a similar pressure from the scale of development that's going on in the life science space. So, with that background in mind, like how do you best plan to manage the risk of that when you're trying to plan your own commercial project and that these factors are going on? And I think the key to success, there's nothing overly revolutionary about it, is continuing to get further ahead in all that you do to plan a project. So you see on this graphic like the timeline of a typical project, and over the years we've all learned how to fast track projects and have some overlap in the different major phases of a project. But it's now like we're at this point where we have to even think about, like, I'll dub the term maybe even faster tracking. And maybe that's almost more essential just to maintain the same completions that you benefit from when you fast track. And the things you have to think about, like, for example, in pre-planning, it's not just a given that the utility companies and the local permitting authorities can just expedite your project. Our customers really have to do more work to kind of research what is possible so that they know those things are in place when they need them. In the design and engineering space, we're seeing more customers engage the contractor, like ourselves, at the very beginning of design. So almost the same time the engineering team is brought in, so is the contracting team, because it's an opportunity to identify the long lead requirements that might require early purchasing decisions. It's an opportunity to get everybody aligned and moving in the right direction on the overall project schedule planning, and also to put together early procurement plans, which is kind of that centerpiece here. And things you can do there, and I think that we're seeing a lot more of, given that we know site labor is constrained by these sectors that are really growing fast. And we touched on it in our fall webinar, looking at opportunities to pre-manufacture off-site large components of the project, particularly pieces like an energy plant or a switchgear room that can be manufactured and delivered in single pieces or assembled as multiple pieces with labor from other locations to kind of distribute the workforce, not just to the site, but to other locations. So that's a key thing being considered in procurement. Also looking at best value procurement of trade contractors, not just who has the best price, but who has the capacity and capability to deliver with some certainty. In the construction phase, our teams that are building schedules are looking at how to create float in the critical path, challenging the stacking assumptions of schedules to avoid getting into an over-aggressive and overly optimistic view of what's possible given the risk of resources. And optimizing the conditions on site. Make your site as attractive to the workforce as you can. Offering the facilities for breaks and those kind of things sounds small, but to the degree you can really respect the challenge of getting the right workforce on the site, those things make a big difference. And then finally, in the commissioning phase, bringing the commissioning entity into the project early in design. Make sure all parties, the general contractor, the key trade contractors, are aligned. Having the design and commissioning team invested in or having an investment in them to be on site during construction to expedite decision making that you'll run into. Also good practices. So just kind of continuing to get further left in your planning activities will benefit the potential outcomes that you can have on the project.
Yeah, thanks, Steve. I mean, just the earlier the better, but I like how you just took us through all the different aspects and how to kind of move that to the left, as you say. Switching gears a little bit, Rob did such a great job of explaining what tariffs are and are not in effect, which is quite the feat these days. Yet the tariff impact can take a while to work its way through the supply chain to affect price increases. Do you think tariffs are going to raise costs this year, or do you think the continued uncertainty around tariffs and kind of what country is going to get what type of tariff is going to lead to cost increases later this year?
Yeah, at a high level, I would say I think the impact we have felt from tariffs has been somewhat less than we expected. In terms of the meetings that we held last year when we were explaining how to look at tariffs and what maybe to budget in terms of a tariff contingency, that new term we introduced last year, given what we've seen all year. I think most of my team around the country have reported they haven't quite felt that being absorbed into their cost proposals. But I do think there's been a lot of work by the manufacturers to change supply chains to minimize the impacts of tariffs. To their credit, right? Like they weren't just victims of the tariffs. A lot of manufacturers were looking at how can I use the tariff constraints to gain an advantage. So I think we had, in most cases, a better result. But I do think we're going to maybe see tariffs we're going to start to feel that more. That's what my gut says in 26. I think domestic capacity will be strained by these bigger sectors. And you're not going to be able to avoid maybe some offshoring, even though you might want to, because of that domestic capacity. And maybe we'll feel the impacts of tariffs more this year than we have. So I guess I would just continue to recommend teams continue to have a contingency for tariffs in their budgets. I think it's appropriate to continue to be in that sort of 4 to 6% range. Depending on when you've built your budget. You may have built the budget later last year and already built some of that in. Good, that's great. You might have to forecast less of an impact. But if your budget kind of predates the tariffs, I think having that contingency available to you is still going to be to your benefit.
Okay, will certain industries be more affected by the tariffs because most of the building materials are not manufactured in the U.S.?
Yeah, it's a question I get a lot. I would just say we all share common products when we're building the buildings, right? The metals, the different metals that go into making up the equipment that Rob mentioned. You might experience, a higher concentration of the metal products in a higher tech project. So maybe you'd be on the higher range as a percentage for tariffs than others. But I don't think that's the bigger issue with tariffs. I do think that sectors like data centers and life sciences are getting much more deep with the manufacturers directly and have large orders with these manufacturers that are impacting and making it more difficult for a customer who just wants to develop a single project to be able to get their products. But I think that's less to do with tariffs and more to do with sector growth.
Yeah, that makes sense. And I think we're going to hear a little bit more about sector growth with Ken in a second here. So, Steve, thank you so much. I think we've already gotten a few questions in the chat for you that we'll take at the top of the hour. But if you have any other questions for Steve, please add them to the chat. So appreciate that. We're now joined by Ken, and I think, Ken, I don't think you have your screen on, so I don't know if you want to add. There we go. Okay. So Ken's going to talk about the bigger economic landscape and how that'll affect the construction industry in 2026. So I still don't see you, but can you talk and maybe we can hear you?
Yes, and
Okay,
let me know.
good.
Yeah, okay, good.
We have
Yeah,
you.
I'm having to do this from the Raleigh-Durham airport, and they did have a hiccup with the Wi-Fi, and then also an alarm went off, but fortunately that stopped for now. But just in
Okay,
case
great.
people have to, if I do have to get off or get knocked off suddenly, let me just say I'd be glad to hear from people at ken.simonson, SIMONSON, at agc.org. As I mentioned at that outset, I'm the chief economist for Associated General Contractors of America. I hope everyone on the call knows about AGC, but do go to agc.org to find out where your nearest chapter is. What I want to cover today is what our members told us they expect for 2026, and then what's going on with construction spending so far. So let me start with the results of our annual Outlook survey. This question was, do you expect the dollar value of projects available to bid on to be higher or lower than the year before? And the bars represent the difference between the percentage of respondents who expect the market to be stronger minus those who expect it to be weaker. Not surprisingly, the most optimism was about data centers. In fact, the difference between optimists and pessimists, 57 percentage points, was the most we've seen for any category in the 15 years we've been doing this survey. And it was a jump from a net optimism of 42 percentage points, already the strongest of any submarket a year ago. Specifically, 65% of respondents said they expect the market opportunities to increase. Only 8%, and I can't imagine who those are or where they are, thought the market would shrink. There was also a slight increase in net optimism for power construction, up by 2 percentage points. But for the other 15 categories, there was a decline from a year ago. In fact, overall, a decline of 9 percentage points, pretty significant reduction in net optimism. And for 10 of those categories, still more optimists than pessimists, almost as many as last year for medical projects, whether hospitals or anything outside a hospital. Also positive for water, sewer, manufacturing, transportation, bridge, highway, slightly positive for warehouse, federal, whether it's for military construction like Army Corps or NAVFAC, or for civilian agencies like GSA. Slightly positive for multifamily, just about a break even between pessimists and optimists for public building. And then 5 categories, the pessimists outnumbered the optimists. That compares to just 2 categories a year ago. This year, the pessimism was greater for for K through 12 schools and for higher education, for lodging, for private office and retail. Last year, it was just private office and retail, and those people have gotten much more pessimistic. Well, moving on to what the data show has actually happened in the last 12 months, we get figures from the Census Bureau every month about construction spending put in place. That's spending on projects already underway. It is not adjusted for inflation, however. So this is actually a somewhat rosier picture than if you were measuring the square footage or some other unit measure. And what it shows is that total construction slipped a little bit from December 2024 to December 2025. That is, that black line is below the horizontal gray line of no change and was throughout 2025. But there are three three important segments that you could divide construction into. Private residential and private non-residential were both down slightly, whereas total public construction was still growing. But you can see that all of these segments, including public, have slowed down a lot from just earlier in 2024 or before that. In fact, these figures come off the census press release. The next slide shows the detail that you can only find by going to the census.gov/construction spending, where they have 4 Excel files of historical data for private, state and local, federal, and total construction. Well, I've done the hard work for you of digging through those Excel files, and there are 170 subcategories of non-residential construction. And what I've come up with is what I call a checkerboard here, a mix of increases from December of 2024 to December of 2025 in black and decreases in red. So at the top, you see that total decline of 0.4%, residential down 1%, but within that, a more significant drop off in single family, down 4, multifamily up 3. I think this year, if interest rates hold where they are, and we got a report an hour ago that the 30-year fixed mortgage was right at 6%, just up 2 basis points from 5.98% last week, which was the lowest since 2022. If they hold near that, we'll see a gradual pickup in private single-family home buying and then construction late in the year. Multifamily spending on projects underway already up a little bit, but again, interest rate costs and also a slowdown in population growth that I'll get to later has really dampened the outlook for multifamily. So I don't think it's going to get any stronger than this. The rest of the table shows the non-residential categories as defined by the Census Bureau and listed in descending order of December 2025 size. They include both new construction, reconstruction, repurposing, and so forth. And as I said, they're not adjusted for inflation. By far, the biggest subcategory is manufacturing construction, and that was also the one that had the biggest decline, in contrast to a couple of years ago when it was the hottest submarket. Specifically, a huge downturn in what Census calls computer, electronic, and electric manufacturing. That's those semiconductor fabs that seem to be springing up everywhere, but then Intel put the brakes on its huge project outside of Columbus, and TSMC finished its first project in Phoenix. However, now TSMC is doing more work, and Micron announced that they're going ahead with a long rumored and somewhat delayed project in upstate New York. Other things still going on. So I do think that the semiconductor fabs will be a positive contribution this year. The next biggest subcategory is what Census calls chemical construction. And this ranges from pharmaceutical plants and R&D for pharmaceutical or bio, and on the other extreme, natural gas liquefaction trains. Both of these look like they'll be up strongly again this year. On the negative side, transportation equipment, which had been the third strongest category, so many projects have been canceled, scaled back, or stretched out to build EVs and batteries for them, that I think this will continue to be a drag. And then we do have some examples of individual companies ramping up production or building new or expanded plants to meet the demand from data centers and power projects. So on the whole, manufacturing is not going to be as bad as it's shown here, but there's still hesitancy by firms that wonder what their tariff costs are going to be. Power construction, I agree with our members that this will be a growth market, both for generation of many kinds and for battery storage at power plants. Highway and street construction, probably continuing more or less flat. Educational looks like it's flat. In this particular period, both the K through 12 and the higher ed were down, but because there's a grab bag of other things that Census includes in education, from pre-primary to libraries, museums, and so forth, the total educational market looked to be flat. The important piece is K through 12 and higher ed. I think the K through 12 market will be fairly stagnant, but higher ed is likely to decline. We're seeing a continuous decline year by year in the number of high school seniors as the baby bust works its way through the grades. And also, this administration has deported or made it much harder for people to get visas to come from abroad as students or faculty or researchers. So universities and colleges have much less need and less ability to pay for new dorms, classrooms, and other structures. There is an exception, though. Community colleges that are offering career and technical education are finding huge demand, and they will be expanding. Commercial is a term that gets used in a lot of different ways. For census, it means warehouse, retail, and farm construction. Warehouse market is generally still in decline, but there is demand for so-called last mile distribution points within metro areas for temperature controlled storage and for selected other warehouse. Retail will also be spotty. It depends on where new population is showing up, where that multifamily or single family starts growing. But if you're close to an office market that still has not attracted workers back, retail is likely to be in decline. Office is the most deceptive figure in the census press release because it still includes data centers. You have to go to this private Excel file, a private construction Excel file, to learn that data centers were up 29% last year, while other private office construction down 14%, and public office also down. Now, I don't think that data centers can compound at a 29% rate, but I still expect strong growth, whereas for other private office, still decline. Healthcare, again, the three subcategories. Hospital, certainly the big medical centers and teaching hospitals, they're always doing construction. But the whole community and local hospitals continue to close their doors or get consolidated. So I don't think hospital construction will grow. Instead, the action is going to be in those special care facilities, ranging from standalone urgent care clinics to specialized testing or diagnostic facilities, long-term care, hospices, and so forth. Transportation, also a bunch of different modes and public and private. As I said, I'm sitting in an airport now right next to construction that is expanding the terminal, adding gates, many other airports changing the mix of retail and restaurants and putting in luxury clubs, making airside and landside improvements. So air looks like a solid market for both building and civil engineering for the next construction for the next year or more. Whereas transit, definitely disfavored by this administration and Congress, likely to keep declining. Well, across the bottom of this screen, I've squeezed the other 8 categories the Census Bureau mentioned or provides data on. They only total 7% of the total, but I'd be glad to take written questions or an email about them. Let me move on to talk about what our members' major concerns were for 2026. And I should mention, this survey was conducted in November and the first half of December. We got a total of 951 responses from all over the country. We gave them 19 choices to list for their major concerns, and also they could write in what their major concerns were. We didn't ask them to rank the choices or list a certain number, but the one that was mentioned by the most respondents, 62%, was an economic recession or a slowdown. And while the data so far for the fourth quarter and the first couple of months of this year have been more positive than some economists, and in fact me expected. I think the risk is certainly there and has been elevated by the war going in the Middle East and spreading in the last few days. 4 other items really always show up as major concerns: insufficient supply of workers, rising direct labor costs, whether for pay or benefits or taxes, worker quality, and then materials costs. But this year, a large minority, 44%, said they were also concerned about increased competition for projects. And that fits with the first slide survey result showing far less optimism and therefore more expectation that bidders would come in from other areas, bid on smaller projects than they used to, or bid on types of projects that they hadn't before. Well, let me switch to what's happening to costs. You've already heard quite a bit about that. I look at the producer price index for inputs to new non-residential construction. This comes from the Bureau of Labor Statistics each month, and it showed that from January of 2025 to January of this year, that weighted average of the cost of all materials and services such as design and trucking services went up 2.9%, somewhat more than the consumer price index. And certainly from February 2020, the month before the pandemic hit, construction has been hit much harder than consumers, who are rightly irate about having such a steep increase that's still continuing. Well, as you've been hearing, the major impact on this PPI is the tariffs on aluminum, steel, and copper, up in the last 12 months by 33 and 21 and 16% respectively. And because construction machinery is basically all steel with copper wiring and electronics that contain copper, that's also gone up at an elevated rate of 4.7% in the last 12 months. I think that we'll also see impacts from the war. We've already seen diesel and gasoline prices jump at the retail level. Obviously, contractors use a lot of both fuels for trucks, and their workers do also, but also for all construction equipment. And then we'll see the unpleasant return of fuel surcharges on the thousands of deliveries of materials and equipment to job sites, and the hauling away of equipment, debris, and other things at the end of a job. So construction definitely is in the crosshairs of any impact from what's going on in the Middle East war. Let me talk for a minute about labor costs, or let me just mention that our members were affected by tariffs. About a quarter of them said not affected, but 40% said they'd raised their bid prices. A third had passed most or all tariff costs on the project owner, and a third said they had accelerated purchases. Well, that was in 2025 when many tariffs were announced with a lead time. Now they're generally in effect, so I don't think accelerating purchases is still a viable option. Let me talk just for a moment about labor costs. We get 4 measures of these. Every month as part of the employment report, which we'll be getting tomorrow, we hear a measure called average hourly earnings for production and non-supervisory employees. In construction, that refers to most craft workers and office workers who aren't supervisors. And that pay has actually been going up a little faster recently, 4.7% from January of last year to this January, whereas it's been cooling off, decelerating in the total private sector to less than 4%. A more sophisticated measure that BLS puts out every quarter is called the Employment Cost Index. And similarly, that's gone up at a more than 4% rate for construction, less in the private sector. AGC and a dozen other associations support the Construction Labor Research Council, which analyzes first-year settlements for construction union contracts, and they found in 2025, those went up at a 4.7% rate, much more than the 2 to 3% of contracts that were expiring, that had expired and been signed in 2021 or 2022. And then the firm PAS, for over 40 years, has surveyed construction firms about salaries that they pay support staff and executives. And they found in their latest survey in October that firms were expecting to increase pay 4% in 2025. So I think all of these measures suggest that wages are going to continue going up, or labor costs continue to go up at a 4% rate or greater this year for construction, more than the rest of the private sector. That's not so great news, but it does mean firms have a better chance of attracting and retaining employees. Well, one thing that will certainly affect labor supply is what happens on immigration enforcement. In our survey, only 6% of firms said that they had been visited at a job site or offsite by immigration agents, but 11% said workers had left or failed to appear because of actual or rumored immigration actions, and a quarter said they hadn't been affected themselves, but some contractors had lost workers. Since this survey happened in late 2025, at that point, the Department of Homeland Security had shifted from going to job sites to community action, most notoriously in Minneapolis. But I think that this year, given that they've been granted a record amount of funding, staffing, and resources for building up the supply of immigration enforcement agents, we will see a return to job sites. And as the next slide shows, construction is much more vulnerable on this count than other industries. 35% of construction trades workers were foreign-born. Not to say they were illegal. Many of them have been here for decades, maybe citizens, but they were born abroad. The states in deep green, Texas, California, Florida, Nevada, Maryland, over 50% of the craft workers were foreign-born, whereas the states in bright red, mostly in the northern tier, single-digit percentages. But it also varies a great deal by trade. So the next slide shows the building and development crafts, floor, wall, insulation, ceiling, roof. Over half the workers are foreign-born, whereas crafts that require extensive training, certification, apprenticeships, such as construction equipment operators and electricians, slightly less than the overall percentage of workers. Well, let me wrap up with two observations. First, the policies that have been affecting construction are likely to have a significant effect this year. First of all, higher tariffs. You've heard a lot about those, but it's not just the impact on construction. The tariffs are certainly causing some manufacturers to hold back on projects, but they're also affecting businesses that depend on foreign visitors. We saw a downturn in visitors from Canada and other foreign countries. And I think that will be true even more this year. So many resorts, entertainment facilities, some restaurants, and retail sites will also hold off on construction that might otherwise have taken place. Immigration and deportation actions have already meant a huge drop in net immigration, and that's cutting off some of the supply of workers who would have replaced those who are leaving the industry either voluntarily, out of fear of showing up at job sites, or because they're actually deported. And it also means that geographic markets that had seen a growth in population because of immigrants may suddenly see less demand for housing, schools, retail, and other consumer-facing projects. Large deficits are keeping interest rates high. That's not just a problem for 30-year fixed mortgage rates, but for municipal and private activity bonds. If universities, hospitals, and local governments have to spend more on interest costs, less available for construction. The One Big Beautiful Bill Act did keep corporate rates low, and it added expensing for equipment, R&D, and some structures, but there has to be demand for what that structure would produce before you see a growth in spending on construction. So finally, let me say, I think the medium-term outlook remains very fraught, and more so since this war broke out last weekend. While our members were worried about recession, so far we haven't seen a sign of that, but the risk of both recession and inflation has grown. In terms of what I expect for construction, I'm hopeful we'll see a gradual pickup later this year for single and multifamily. I think warehouse, office, and higher education construction are going to be in decline. Brightest prospects are for data centers, power, airports, especially healthcare. Manufacturing, certainly a mix. Materials costs up to between 2 and 4%, maybe less if you're buying things that don't have import competition or tariffs, like concrete, glass, insulation, but certainly fuel costs are likely to drive up more costs. And labor costs up 4 to 5%, but for a given project, much worse if you find your workers are either carried off or stay away. So with that, let me just suggest that people look at agc.org for a lot of other information, including a tariff resource center that we try to keep up to date every day. And also, if you'd like to get the Data Digest, my weekly summary of economic news relevant to construction, or you have questions that we don't have time to answer here, feel free to email me at ken.simonson@agc.org. So thanks, and I'll turn it back to you,
All right, thank you so much, Ken. I'd like to ask Rob and Steve to join us once again, and we'll take a few questions. Honestly, most of the questions that have been in the chat or in the question and answer, I think you guys have answered most of them. There's one I don't think we got to. Does over-ordering occur in data center construction like it does in semiconductors? I thought maybe this might be a good one for you, Steve. You're on mute, Steve.
Say that again, Katie. I just want to make sure I understand that a little bit.
Does over-ordering occur in data center construction like it does in semiconductors?
Yeah, what I would take that to mean, maybe probably be interested in some more context. I do think a lot of what we're seeing from those developing data centers at all different scales, to a degree, is in anticipation of needs. And so is there some growth beyond what's the demand actually is at the moment? I don't want to suggest that I'm an expert there, but I believe there is that, right? That a lot of investments being made in anticipation of the continued massive expansion of what AI can do for the world. So yes, I'd say the short answer.
Okay.
And I can add to that too, Katie, like
Yeah.
just touring some of the data center campuses that we're building. I have seen them order ahead. So when you go to a campus, there'll be a couple of buildings going up and then there's more planned. So there may be some backup power generators that are there on site and ready for that next building. But I don't think they're over ordering. I think they're just ordering ahead a little bit.
Okay. Okay, great.
Yeah. Okay.
Yeah. Ken, I know you talked a lot about immigration changes and kind of the labor supply in construction. I know the numbers are coming out tomorrow, but the job growth in January was higher than I think a lot of people expected. And the construction industry has gained 33,000 jobs, but lost 1,000 jobs in 2025. Are we on the better track for labor supply in construction, or are we still kind of at a dividend?
Well, you're right. That figure for January was a very pleasant surprise. It followed a downward revision for many of the months of 2025 and showed, in fact, construction employment had basically been flat the entire year. And of course, the Bureau of Labor Statistics and other statistical agencies were definitely affected by the government shutdowns, the record 6-week shutdown on October, November, and then a brief one at the end of January, beginning of February, a crucial time for getting those monthly job figures. So the February report that will come out tomorrow, I think will be looked at with even more than usual interest to see if the January numbers get revised more than usual, either up or down, and whether any trends have continued in February. But then, of course, the February numbers were also affected by severe weather in many parts of the country in January and into February. So I think it will be a few more months before we really know which way things are headed. At any rate, the contractors continue to say that it's difficult to find and replace skilled craft workers. There's been a heartening increase in the number of students going into career and technical education programs and of community colleges and high schools offering those programs. But that's a long pipeline before you can replace somebody who's retiring. And so I think we are going to have chronic difficulty finding people with the right skill set.
Yeah. Thanks, Ken. It definitely makes sense. Hopefully we can build back some of that backlog. I think, we've answered most of the questions in the chat, so we can probably wrap up early, but maybe just one thing to leave our audience with here today. I mean, it still sounds like there's quite a bit of uncertainty around the direction of 2026 still, and I know starting earlier, getting to the left, but Steve or Rob, is there any other advice we want to leave our customers with on how to navigate this year?
I think we covered most of it, Katie.
Okay.
I would just I would just challenge old assumptions that have always routinely been the go-to, right? Continue to think about what may have been one time more predictable, may be less predictable now, and the way to abate that risk is advanced planning, right? And just challenging assumptions, making quicker, earlier decisions to purchase. I always say that the price of construction rarely comes down. I think a wait and see approach probably isn't going to lend itself to a lower first cost. So to the degree you can, just keep advancing your planning and thinking on your projects sooner in the life of the planning phase of a project.
For me, I'd go back to one of the comments I made earlier about specifications, right? The more you can allow for flexibility in your specifications, the better off you're going to be for a couple of reasons, right? From a price point of view, these major manufacturers, multinational manufacturers, they have extensive supply chain teams on staff, and they're always looking for ways to resource things, minimize the impact of tariffs. So the impact's going to be different by manufacturer, right? So you want to be able to shift if you need to, but also thinking about lead times. There's also other sources that have longer lead times than others. So another reason to kind of build in some flexibility to your specifications. You know, I'm a big believer that procurement starts when the designer's pencil goes onto the paper. Mm-hmm. That's when procurement starts.
Yeah, great. Thank you for that. We did just get 2 new questions into the Q&A. So one of them was, has anyone looked at the interior finishes cost versus the building cost and what the trends are, you know, for early this year and maybe last year?
Yeah, I don't think, you know, we're not plotting anything like that or indexing anything. I have the feedback I receive from most of my pre-construction leaders around the country is the predictability and pricing for the interior trades has been better, usually less vulnerable to steel, aluminum, copper as some of the other trades. So it seems as though that's like a bright spot overall in terms of cost escalation. Like those trades have been continue to be a little more stable and predictable.
Yeah, I would agree. Absolutely.
Okay. I would add that one source I look at is that there are producer price indexes for 4 different subcontractor categories, and each month when those come out, I send out that data I discuss it and link to tables that show how those are changing in my data digest. So I'd be glad to forward that information on what's been happening with subcontractors as well as with specific materials, and then that overall cost I showed for inputs to non-residential construction.
Okay, yeah, that makes sense. Thanks, Ken. Another question, and I think, Steve, you touched on this a little bit. Are your teams experiencing a notable rise in modular and prefab demand with persistent labor and skilled trade constraints? Is this driving greater contractor willingness to explore these methods? And we talked about this a little bit in our last webinar, but Steve, do you want to just expand upon that a little bit?
Yeah, I think definitely more interest. Often we find ourselves being the promoter of that and the advocator for that. So I think it's picking up steam. As you saw in the fall webinar, more and more entities are being formed to offer offsite prefabrication, modularization. There's a learning curve with that though, and sometimes there's a skittishness, if you will, to jump into that. But I think you know, the necessity of it is becoming more and more real, and the capacity to deliver it is out there. So I just continue to recommend to teams to have an open mind, think about the design of your project and what could be what could be done off-site. Investigate the right partners who can do that with you, because it's there. And I thought the great story we told in the fall webinar about building an entire energy plant off-site and how much that took off of the capacity of the craft workers on site so they could focus on the building. It's a great story. And I think we absolutely have to, like, in our industry, keep driving that, because I think that's, what it's going to take to meet demand in the longer run.
Yeah, definitely. Okay, I think we might have one more question. Are there regions that are performing better than other ones? And I think, excuse me, it's in regards to number of projects. And I know, Ken, I know you talked kind of about how different markets are trending in different subsets, but any thoughts on how different regions are trending?
Well, we do get data from BLS on construction employment by state, and also for 360 metro areas. Unfortunately, they haven't done the revisions to the state and local that they did to the national. That won't be coming out until April. But based on the figures that they had posted through December, 34 states had an increase in construction employment in 2025. That's still pretty strong, but it's down from 40-some in 2024. And specifically, while we had already seen weakness on the West Coast and much of the Northeast, weakness was showing up in several southeastern states and in the midsection of the country, Intermountain states or upper Midwest. We'll have to see if that continues. Some states, every metro area, I'm in North Carolina, just gave a presentation to their state construction conference. All of the metro areas in North Carolina showed strong construction employment growth, but many other states, it's a mix of gains and losses. And I think it really depends on where within a state things like data centers or new power projects are happening, or one-off things like a large manufacturing plant or perhaps university or hospital construction. So it's hard to generalize, but the story does keep changing.
Yeah, and I think, Steve, in our report, when it kind of shows what the inflation expected for local market, kind of also gives you a little bit of a lens into how busy that market is. As well as the Architectural Billing Index, which does it by region. And I think the Midwest has been one that's been trending a little bit higher than some of the others. So that can kind of give you a little bit of a forward looking as to what regions might be more busy, but a lot of different factors at play there. So, okay, well, I think we are just about 2 minutes away from our timeline here. So we're going to wrap it up. But if you have any other questions, feel free to add them to the chat or contact us directly. And I just really want to thank all our panelists and everyone that joined today. Ken, thank you for joining us as well. And please be sure to check out our full report. So thanks, everybody. Have a great day.
Thank you.